Welcome back to Explain the Charts, your essential guide for navigating the complexities of financial markets. Today, July 22nd, 2025, we're putting the spotlight on USDJPY, a currency pair that has captivated traders with its recent dynamic movements. Current events from major financial news outlets present a nuanced and somewhat conflicting picture. FX Street highlights a notable dip below the psychological 147.00 level, indicating a potential waning of bullish momentum, while simultaneously mentioning a recovery effort pushing towards 148.00. This mixed sentiment is echoed by MarketWatch, which reports a general weakening of the dollar due to increasing expectations for U.S. interest rate cuts, yet also notes instances where the dollar has recently strengthened on inflation data and tariff discussions. Meanwhile, the Japanese yen's performance, according to investing.com, shows small gains, although the Bank of Japan's stance remains largely unaffected by recent political events. It's crucial to note that current live quotes from sources like Yahoo Finance already show USDJPY dipping further to around 146.512 this morning, which is a key development even after our latest available candlestick data concludes for yesterday. This immediate post-data price action suggests continued strong bearish pressure. The interplay of these global economic factors makes USDJPY a fascinating, albeit challenging, pair to analyze. Let's first establish our bearings by examining the one-day chart, encompassing the comprehensive price action over the past year. Observing the period from March 2024, USDJPY embarked on a significant and sustained uptrend, climbing steadily from approximately 147.00 to an impressive peak of 160.185 by late April. This 160.00 psychological mark clearly acted as a formidable long-term resistance level, triggering a sharp and undeniable reversal. What followed were notable deep pullbacks in May and July of 2024, where prices plummeted, unequivocally testing and often breaking prior support zones. The area around 145.00, in particular, frequently emerged as a critical support level during these bearish corrections, indicating strong buying interest at those junctures. These sharp declines often coincided with shifts in market sentiment regarding central bank policies or global economic data, underscoring the pair's sensitivity to macroeconomic factors. After these major corrections, the pair entered a period of more volatile range-bound trading through much of late 2024, characterized by attempts to recover lost ground. Transitioning into more recent times, specifically from early 2025, the daily chart reveals a renewed but ultimately unsustainable bullish push, with the pair attempting to reclaim higher grounds above 155.00 multiple times. However, the prevailing narrative since March 2025 has been a gradual but clear shift towards a downtrend, punctuated by strong bearish candles. We can highlight the significant drops observed in April and again in early July of this year, which saw USDJPY shed substantial value. These prominent daily price declines, often accompanied by increased trading volume, directly align with the news indicating an acceleration of U.S. interest rate cut expectations. This reinforces the correlation between the market's pricing of future monetary policy and the immediate currency movements. The volatility underscores the ongoing struggle between dollar bulls anticipating resilience and dollar bears betting on continued Fed easing, directly influencing the yen's relative strength. To understand the granular details of the recent dramatic price action, let's intensely scrutinize the 15-minute chart, focusing on the past few days. Here, the sharp decline reported in the news becomes vividly clear. Beginning late yesterday, July 20th, and intensifying into July 21st, specifically from around 5:56 Universal Time Coordinated, we witness a rapid and significant sell-off. The price plummeted from approximately 148.18, breaking decisively below the critical 148.00 level, and then accelerating past the psychological 147.00 mark, reaching lows around 147.08 within a compressed time frame. The large red candles during this period, coupled with noticeably higher trading volumes, confirm strong bearish conviction and a decisive move by sellers. After this initial plunge, the pair entered a phase of consolidation around the 147.20 to 147.40 range for the remainder of July 21st, as traders digested the rapid shift. This immediate short-term weakness is what led to the headlines about USDJPY dipping below 147.00, and as we noted, the price has continued to extend its decline into today's trading. Therefore, this critical 147.00 level has transformed from a support to an immediate resistance, requiring significant bullish impetus to overcome. Stepping back slightly to the 1-hour chart, covering the period from July 2nd to July 7th, provides valuable context for the broader short-term trends leading into the current volatility. During this interval, USDJPY largely oscillated within a contained range, primarily between 143.50 and 145.80. We can observe a noticeable bullish spike around 12 o'clock Universal Time coordinated on July 3rd, pushing the price momentarily above 145.00, driven by a cluster of green hourly candles. However, the subsequent price action showed these gains were not aggressively sustained, indicating either profit-taking or a lack of strong follow-through from buyers. The general sideways to slightly upward movement within this hourly window suggests a period of accumulation or indecision, which eventually gave way to the sharp downtrends seen more recently. This highlights how smaller timeframes can reveal early signs of weakening conviction, even before major daily moves unfold. Now, let's synthesize this analysis into actionable insights for trading USDJPY. From a bullish perspective, immediate re-entry into an uptrend would necessitate the pair decisively reclaiming and holding above the 147.00 level. Successful sustained closes above this point would then set the next targets at the 148.00 resistance and potentially the significant 150.00 psychological barrier, where further challenges might arise. Such a reversal would likely be contingent on an unexpected hawkish shift from the Federal Reserve or strong, definitive positive outcomes from the US-Japan trade talks. On the other hand, the bearish argument currently holds significant weight, heavily reinforced by yesterday's substantial drop and today's continued lower opening. If USDJPY fails to recover above 147.00 and momentum continues downwards, the next crucial support level to monitor is 145.00, a historical pivot point. A decisive break below 145.00, especially on increased volume, would signal a strong continuation of the downtrend, potentially pushing the pair towards 142.00. This could be triggered by more aggressive Fed rate cut expectations or a surprisingly dovish turn from the Bank of Japan, though current news downplays the latter. Therefore, your trading decision should heavily factor in price action around these identified support and resistance zones, alongside ongoing fundamental developments. To summarize our in-depth analysis for USDJPY, the pair experienced a sharp decline on July 21st, breaking below the 147.00 mark, and has shown continued weakness into July 22nd. Important resistance levels to monitor for any short-term bullish recovery are 147.00, then 148.00, and finally 150.00. Conversely, crucial support levels to watch closely are 145.00 and, if breached, 142.00, which would signify a deeper bearish correction. Our unbiased prediction leans towards continued bearish pressure in the short to medium term, with an estimated 65 to 70% likelihood, assuming no immediate significant shifts in economic outlook or central bank policy. This prediction is reinforced if U.S. inflation data cools further and the Fed signals more dovishness, or if global risk sentiment improves, dampening demand for safe haven dollar assets. A potential rebound, with a 30 to 35% likelihood, would depend on a sudden, stronger-than-expected U.S. economic recovery or a hawkish surprise from the Federal Reserve. For traders, constantly monitoring upcoming economic indicators, particularly U.S. inflation and employment reports, as well as any official statements from the Federal Reserve and Bank of Japan, will be paramount in confirming or refuting these potential scenarios and guiding your entry and exit points.